Hi folks, Kevin Reardon coming to you from Shakespeare with a market update. As you know, we do not time the market. We do not make market bets, but rather invest in diversified portfolios and rely on our investment disciplines to guide us and really manage volatility that's out there. With that said, we have noticed and we were able to identify trends that happen in the marketplace from time to time. And we've noticed a pretty definitive trend that's developed in which large cap growth companies have gone through a period of substantial overperformance. So it's our experience, and there's decades of documentation, where an asset class, if and when it outperforms other asset classes, that invariably that asset class reverts back to a mean or back to an average return. In other words, the securities that had previously lagged start to do well, and the securities that had previously been doing well begin to underperform. So we're going to take a look at that today. Before I move to the next slide, let's first define growth versus value. Growth companies are newer companies and companies with newer product lines, newer technologies. So it's technology companies and biotech companies, things like that. Names that would be familiar to all of us would be companies like Amazon, Apple, Microsoft, Google, Facebook, Netflix. Those types of companies would be growth companies. Value companies are more traditional companies with more established product lines, more established and consistent cash flow, more established vendors, established banking relationships, and things like that. Companies that would be considered large cap value would be companies like Procter & Gamble, Kimberly-Clark, Pepsi, the airline stocks, railroad stocks, banking stocks, companies like that. And really the most visible value investor out there is Warren Buffett. So companies that he would buy are considered value companies. All right, so let's take a look at this diversion that we've seen between growth and value and make some judgments. So this is the periodic table from chemistry class from freshman year of high school. If it makes you a little queasy, join the crowd. I always get a little queasy looking at this graph because it makes me think of being a 15-year-old in high school. Each column here represents a year. And in each column, we list the top performing asset class each year, obviously at the top, and the lowest performing asset class each year at the bottom. If I can have you zero in on orange, which represents large cap growth, you'll see this trend where large growth has been near the top quartile for the better part of 10 years, okay? Now, it's human nature to say, this is done really well, why don't we just continue owning more of this? And I think we all understand why, is that invariably something that's done exceedingly well invariably goes through a period of underperformance. And if we look further in the graph, we can see periods where orange has been near the bottom quartile for a period of time. And so that's an example of reversion to the mean. If I was able to show you the 1990s in this graph, we would have seen large growth near the top quartile for several years in a row. And obviously the 2000s, the early 2000s, large growth didn't do very well. And actually, if I just have you look at yellow, that's international. You'll see in recent years, international has been near the lower quartiles pretty consistently. And so people might argue, why should we own international? And the reason is that invariably it reverts to the mean and has periods of outperformance, like we saw in the early 2000s. So let's take this a step further and let's look at some of the numbers here. Okay, so we have large cap indices, mid cap indices, and small cap. And we break each indice down by growth and value. So some initial observations. you can see large growth through May 26th was actually positive 3%. Large value was a negative 17%. That's more than a 20% differential. These are all large cap US companies, but yet there's a 20% return differential between large growth and large value. Very substantial. We can see at the mid cap level, growth doing exceedingly better than value, and the same on the small cap, value versus growth. Let's look at the 5-year level. On a 5-year level, large growth at 14%, large value at 4%. That's a 10% differential per year for 5 years. That's not only substantial, but it's really unsustainable. And let me come back to that in a second. We'll see huge disparity between mid growth and value and then small growth and value. And then the last commentary here, look at the difference between large growth at 14% versus small value at 0.78. So invariably, the large cap stocks become overvalued. The price has done really well, but they become overvalued relative not only to their earnings potential, but also relative to other companies that are available for us to invest into. So I am not saying that Apple and Microsoft and Amazon and Facebook and Google and all those great large growth names are going out of business. I am not saying that. And I'm not saying they'll do poorly as companies. What I am saying is that over the next 5 to 10 years, probability in history tells us that those investments won't do as well as value and small cap companies, simply because they become more attractive on a valuation perspective. Okay? Now, our investment discipline, we don't shift per se. We're not taking large bets and saying, hey, let's get out of large growth. Our disciplines kick in when large growth does really well. We sell some of that security, some of the profits back to a target, and we use those proceeds to buy securities that have lagged to make sure that allocation is a good number for when that category starts to outperform. Okay? And then the last slide, and this is a brief presentation relative to my other presentations, simply looks at the performance of various categories 1 year after a market decline. And so small growth 1 year after a market decline on average has done 51%. Small cap diversified portfolios at 48, small value 46, mid cap you can see, growth value. And large cap still good numbers, but they'll lag the small and mid cap numbers. Okay. All right, and so that's really the takeaway from today. I'll point out that it's easy to own large growth names right now. People gain comfort in thinking and owning Apple and Amazon and Google. And we see in the Milwaukee and Wisconsin area a lot of managers who buy large growth companies. Very familiar names. It gives the investor a comfort level in knowing they've owned them. They have done really well the last decade. What we're here to point out is that history has shown us and taught us that everything in life reverts back to a mean return. When you have a category that does exceedingly well, it's always followed by a period where those securities will lag. And here we are, June of 2020, I'm really declaring that large growth is a category that we should be very cautious about. And if you have securities in your 401k or with other advisors that are all large growth, that you want to be really careful with those investments moving forward. All right, if you want to review your portfolio, give us a call. Our team is here, ready to talk to you. Have a great summer, and we'll talk soon. Thanks, guys.